What if I told you there's a 187-year-old company that survived world wars, recessions, inflation spikes, pandemics, market crashes, and still manages to grow your money quietly in the background? Today, we're diving into Procter Gamble, a company so stable, it's basically the financial equivalent of brushing your teeth. You do it every day. You don't think about it, but it literally compounds your life. Let me show you why investors treat P&G not just as a stock, but almost as a wealth-building machine. With roots tracing back to 1837, Procter & Gamble is among the oldest dividend aristocrats. The company is one of the world's largest manufacturers of laundry detergents, baby wipes, diapers, paper towels, cleaning products, shampoos, deodorants, toothpaste, and other consumer goods. Some of the firm's top brands include Luvs, Pampers, Tampax, Charmin, Tide, Cascade, Dawn, Febreze, Head & Shoulders, Old Spice, Pantene, Gillette, Braun, Crest, and Oral-B. Around half of P&G's sales occur outside of North America. The company is currently available with an initial dividend yield above 3%, while the 5-year average was only 2.47%. The price-to-earnings ratio is now 19.6, compared to the 5-year average of 23.8, while the sector average is around 16.2. The stock is currently available at about $138, whereas the expected price is estimated to be between $152 and $186. Based on these metrics, the company appears to be slightly undervalued. The company currently pays $4.23 in dividends per year, distributed quarterly. The next payment will be on February 18th, and anyone who holds shares by January 26th at the latest will be eligible to receive it. The most recent dividend increase was 5%. Over the past 5 years, the company has raised its dividend by an average of 6.1%, and over the past 10 years by an average of 4.6%. For years, the earnings payout ratio has consistently remained below the desired 70% level, and over the next 12 months, it is expected to be around 60%. The free cash flow payout ratio has also stayed below the acceptable threshold for many years, though it is somewhat closer to the upper limit of what is considered healthy in the long run. There is still no cause for concern at this point. Both earnings per share and free cash flow per share have been steadily increasing year after year, with only a few exceptional years. This is exactly what the earnings and sales growth charts show. Slow but stable growth characterizes the company. A key part of the company's strategy is share buybacks, something shareholders typically appreciate, especially when total sales continue to grow steadily, as is the case here. This means shareholders get an increasingly larger share of the company's earnings each year, even if they don't add to their positions. Return on equity and return on invested capital have both been well above the desired levels in recent years. The same is true for operating margin and free cash flow margin. The company's debt level is considered low. Management handles it responsibly, making sure leverage remains under control. The interest coverage chart has also been at very healthy levels over the last 10 years. In short, the company is currently available at a historically high dividend yield of over 3%. Its most recent dividend increase was 5%, and it holds an AA- credit rating, which is considered excellent. The dividend appears to be very safe, and based on the current valuation metrics, the company may be slightly undervalued. It is again best suited for more conservative investors who are not seeking explosive returns, but prefer peace of mind and steady, gradual growth.
Disclaimer. This video is for informational and educational purposes only. It does not constitute financial advice. Always do your own research before making any investment decisions, and never base a financial decision solely on the content of this video.
All right, let's kick things off with the CEO's message. What really stood out to me is the confidence. P&G openly admits the world hasn't been easy lately. Inflation, supply chain mess, consumers suddenly acting totally differently than a few years ago. But they don't sound worried at all. In fact, they framed the whole year as proof that when the world gets shaky, strong brands always come out on top. And in their mind, nobody does strong brands better than them. And here's a fun little detail that explains why they can be this confident. P&G spends over $8 billion every single year on advertising. That's more than Coca-Cola, McDonald's, and Tesla combined. When you wonder why people keep reaching for Tide or Gillette without thinking, yeah, this is why. Brand loyalty for them is not an accident. It's an investment. Now, when you look at how P&G actually operates, they're not trying to reinvent the wheel or chase flashy trends. Their entire strategy basically boils down to a surprisingly simple idea. Make the best possible version of everyday products and improve them every year. Not just good, not almost as good as the competitor. They want superiority. And they measure that across everything: the product itself, the packaging, how it feels, how it smells, how it's presented in the store, even the whole experience of using it. It's basically P&G saying, if ours is better, you'll buy ours. And if we keep making it even better, you'll keep buying ours. And to make sure that actually happens, they use something they call constructive disruption. It sounds like corporate jargon, but the idea is pretty cool. They encourage employees to question old habits, tweak systems, and constantly look for improvements without causing chaos. Think of it as innovation, but with a seatbelt on. 2025 was another classic P&G year. Steady, predictable, and very, very profitable. Share prices were stable, cash flow was huge, and if you're a dividend investor, here's the part where your ears perk up. P&G extended its 68-year streak of raising its dividend. Let me put that into perspective. P&G has paid and increased its dividend through wars, recessions, pandemics. It even outlived the Great Depression. This is why a lot of long-term investors treat P&G like a kind of private savings account that sends you cash every quarter. Now, instead of throwing a bunch of numbers at you, let me paint a simple picture. Imagine a machine that takes money people spend on toothpaste, laundry detergent, and razors, and turns it directly into free cash flow. Then that machine takes most of that cash and hands it back to shareholders. That's basically P&G. Yes, revenue was about $85 billion. Profits were around $15.2 billion, and they returned about $16 billion to investors through dividends and buybacks. But the real story is how unbelievably efficient they are. Inflation pushed up costs, but P&G still protected margins through a mix of smart pricing, relentless cost-cutting, and continued investment in brands. P&G splits its business into 5 main categories: beauty, grooming, healthcare, fabric and home care, and baby feminine family care. But the really crazy part is this. Their fabric and home care segment alone, with Tide, Ariel, Mr. Clean, is so massive that if it were an independent company, it would be one of the biggest consumer goods companies on the planet. And across all categories, they continued to grow organically. Which tells you one thing. Even when people are trying to save money, they still don't want to gamble with low-quality toothpaste or laundry soap. Trusted brands win in tough times. P&G is pushing hard toward net zero emissions by 2040. They're cutting water usage, redesigning packaging to be more recyclable, and making their supply chain cleaner. And this isn't just a PR move. Modern consumers, especially younger ones, actually pay attention to sustainability. And P&G knows that being environmentally responsible isn't just the ethical thing to do. It's also a competitive advantage in the long run. If you want the behind-the-scenes view of the company, this is the section. And the story is pretty straightforward. They raised prices, which helped growth. Volumes didn't really move much, but they didn't fall either. That's important. Raw materials were expensive, but supply chain improvements helped offset the pain. They continued to invest heavily in advertising because protecting brand strength is non-negotiable. Basically, P&G isn't winning because of big, risky moves. They're winning because they're disciplined. They focus on margins, efficiency, and consumer loyalty, not hype. Now, even giants have weak points. Foreign currency swings can hurt earnings. Emerging markets can be unpredictable. Private labels are getting better. Commodity prices can move fast and hit margins. But the good news is that P&G is so diversified across products, countries, and price tiers that these risks become more like bumps in the road than actual threats. These pages are the usual accounting details: balance sheets, cash flow statements, all the technical stuff. What matters is that everything looks exactly like you'd expect from a company often called a forever stock. Low debt, great margins, steady cash flow, predictable earnings. No surprises. And that's a good thing. So what does all of this mean for investors? The short version: If you want stability, P&G is still one of the best places to find it. Their pricing power is incredible. Their cash flow is top tier. The company is quietly rock solid in a world that feels anything but stable. But it's not perfect. Volume growth is slow. That's the trade-off with mature companies. Commodities and inflation can squeeze margins. Competition is always waiting. And emerging markets can add some volatility to results. Conclusion: should long-term investors care? If you're looking for fast growth or excitement, P&G is not going to give you that. But if you want a company that compounds in the background while you live your life, this is it. This report makes it clear. P&G wins with discipline, consistency, brand power, and reliable cash returns. It's not a rocket, it's a fortress. And for many portfolios, especially dividend-focused ones, that's exactly the kind of stability you want.
Thanks for watching, and if you found value in today's video, give it a thumbs up and consider subscribing for more smart, long-term investing ideas. Stay patient, stay consistent, and keep building your path to financial freedom. Until next time, take care and happy investing.